One of the best strategies for giving to charity is a donor advised fund, or you might see referred to as a DAF or DAF. Since the 2017 Tax Cuts and Jobs Act, it doubled the standard deduction, which made it much more difficult for families who give to charity. $500 here, $500 there, $20 here, $20 there. It makes it much more difficult for them to qualify to actually itemize deductions and have that be more beneficial than taking the standard deduction. So for the right family, using a donor advised fund can be something that can save tens of thousands of dollars in taxes in a single year. So we're going to talk about how it works, what it is, who it is and is not a good fit for, and go through an example to kind of demonstrate what those tax savings might be with actual numbers. So let's talk about how a donor advised fund works, just the basics, and walk through it. So a donor, somebody who has cash, or ideally, and I'll get to why in a second, ideally a highly appreciated security. Maybe you've bought some NVIDIA stock or some Apple stock or something that's appreciated significantly and has a lot of built-in capital gain. A donor that wants to give to charity donates those shares or that cash into the donor advised fund wrapper. Once that happens, we haven't given the money to charity yet, but in the eyes of the IRS, we have. So the IRS will give us a tax. We get to take that entire amount as a tax deduction this year against our income. Okay, then within that donor advised fund, we can invest in anything we want, securities, stocks, bonds. We can have that money grow for years and years and years. And then we can give that money on our own schedule to causes, 501c3 charities of our choice. So the key is we're putting the money inside of that donor advised fund, not actually giving it to charity that year. So we can put a large amount in there that not necessarily, we want to write that entire check to our church or to a charitable organization that we're passionate about in that year. But we are getting that tax deduction in that year, which means if that's an appreciated security, something that has a lot of built-in capital gain, all of a sudden we don't care about that capital gain. It doesn't exist anymore. And we get that entire value of those shares as a deduction against our taxable income this year. We can fund a donor advised fund at many financial institutions, Vanguard, Fidelity, Charity Vest is a newer one. But the point is, we're able to donate stock or cash to a donor advised fund in a way that makes sense with our charitably minded goals, as well as our current tax situation and income situation. We want to fund a donor advised fund in a year that makes sense for our specific situation. So we want to be smart about this so that we can not only support the causes that we're passionate about, maybe this year, next year, and for many years, but also do it in a tax smart way that's going to give us the most optimal outcome and pay the least amount of taxes. So now that we know what it is, let's talk about who it may be a good fit for. So it's going to be a best fit for, first of all, charitably inclined people. Giving to a donor advised fund means you're giving away your money. You're giving away your stock. You will not gain money by giving away money. So you need to want to support charities. That has to be an honest effort by yourself. Otherwise, it's not going to financially make sense for you. So you need to be charitably inclined. It's probably the most important one. Number two, people that are not itemizing. So people that make less or have less deductions than that standard deduction amount, which is over $29,000 in 2024. So people that with mortgage interest, property tax, or state and local tax, charitable contributions, like we're not getting to that $29,000. So we're taking the standard deduction each and every year. So our charitable contributions that we might be making weekly to our church, yearly to causes that we care about, those really aren't providing any tax benefit for us. Certainly they're helping out those charities, but we're not currently getting any benefit out of that. And that's a lot of people now in 2024, since that standard deduction is so high. It's going to also benefit those that have lots of built-in capital gains or appreciated securities. So the example that I'll give again is just Apple stock. If it's worth $20,000, we put $5,000 in maybe 10, 15 years ago. We have a $15,000 capital gain there, and that is a huge tax liability that just keeps on growing. So this appreciated security, if we are charitably inclined, donating this appreciated security to that donor advised fund allows us to not only take a larger tax deduction this year and get over the standard deduction amount, but it also allows us to avoid paying any tax on that capital gain. So after talking about who might be a good fit for a donor advised fund, The antithesis of that is who might be a bad fit. So let's talk about that. It's pretty much the opposite. So those who are not charitably inclined, if they are charitably inclined, they don't want to or need to or can't give large amounts of money to charity. So we're talking thousands of dollars, tens of thousands of dollars over a number of years. If we're just giving $20 a month to charity, a donor advised fund's probably not going to make sense for that kind of person. We're talking about people that are giving thousands and thousands of dollars to charity. So those who are not charitably inclined, obviously not a fit. Those who are itemizing already, doesn't mean a donor advised fund won't be a good strategy. It's just less beneficial. And we'll walk through an example to show you why. But those that are already with mortgage interest deductions, with state and local tax, with maybe what they're giving to charity already, like they're already way over that over 29,000 for a married filing jointly in 2024. They're over that standard deduction already. So bunching their contributions together to a donor advised fund doesn't necessarily provide as much benefit as it would to somebody that is under that standard deduction every single year. And then the last one is those without appreciated securities. So again, doesn't mean you can't use a donor advised fund, but it's going to be more beneficial if we do have those appreciated securities that maybe we were thinking about selling and using for something and giving cash to charities, but instead we can be super efficient with those securities, donate those to the donor advised fund, avoid capital gains, and get a large deduction against our income in this year. And it's also not going to be a fit for those who are in lower income brackets. So higher income brackets are going to benefit more from a donor advised fund, and charitable giving in general, they're going to get a larger deduction against their income. Now I want to walk through an example to show you just how beneficial a donor advised fund can be when it comes to giving to charities and organizations that we are passionate about, and also saving on tax. So here's the scenario we have. A married couple filing jointly, $250,000 of wages. So this married couple bought some NVIDIA stock way back when for $25,000, and it has appreciated. It's doubled. So they have $50,000 of appreciated stock. They're super happy about that. And the situation with their deduction situation is they pay $10,000 of state and local income tax. They have $10,000 of mortgage interest, and they give roughly $5,000 a year to charity. So what is that? About 2% of their income. So if you add that up, it's about $25,000. The standard deduction for this year is $29,200. So if they just give that $5,000 to charity, they cannot use that optimally for their tax situation. They're going to be taking that standard deduction because $25,000 does not exceed $29,200. Now, alternatively, if instead of selling this stock, so instead of selling all those shares because they decide they want to give this money to charity and use it for things in their life, if instead they give this money to a donor advised fund, so they no longer have a $25,000 long-term capital gain, and this year they're giving away that $50,000 to a donor advised fund. Now all of a sudden, when you add 50 to their other deductions with the mortgage interest and the state and local tax, their total deduction is $70,000 itemized. Let's take a look at what that actually does to their tax situation. So not only have they gotten to itemize deductions and take advantage of this $50,000 charitable contribution instead of $5,000 a year for the next 10 years, they also are not paying any capital gains. So in the first scenario, let's assume they sell that stock and that's what they're going to decide to put in a high yield savings account and give to charity. In the second scenario, they don't have a capital gain because we donated those shares to the donor advised fund. There is no capital gain. So moving down to their tax situation, what does that do to this couple's tax bill? I'll show you the change in tax. So in the first scenario, we're assuming they live in Colorado in both scenarios. In the first scenario, they're going to have a federal tax bill of $43,777. In the second scenario, it's $29,706. In state taxes, they're going to go from $91.83 down to $67.28. So this couple is going to save $14,000 federally and about $2,400 state tax. So they're going to save about $16,500 on tax this year just by being smart and intentional about what they do with those shares, not selling them, but donating them to a donor advised fund. Now they have $50,000 in a donor advised fund that they can invest for many, many years and give to charities over time, it can grow. They can be even more generous in future years. So to wrap it all up, donor advised funds, or DAFs, DAFs, are super powerful in the right situation. They need to make sense depending on your charitable goals, your taxable income, your future income, and all the circumstances surrounding your personal situation. So just to summarize, it's going to make more sense for those who are in higher income brackets. They are certainly charitably inclined. They are not itemizing, and they have built-in capital gains or appreciated securities that they can donate to that donor advised fund. So I hope this was a useful summary of donor advised funds, how they work, and how they can be super beneficial to the right family in the right situation. If you have any questions, let me know. Would be happy to answer them. My email, it will be in the show notes below. Thanks for being here. Really appreciate it, and we'll see you next time. Thank you for joining us today. Do you want the exact financial planning framework that I use with clients? Go visit baskinfp.com, where you can grab a free download of the ultimate military and veteran financial checklist to give you the bluff on what you need to be doing to manage your finances. We'll be back next week with some more content to help you on your journey to financial freedom. See you then. This is a friendly reminder that the Bluff Finance Podcast is general and educational in nature and does not constitute tax, investment, legal, or financial advice with respect to any particular individual or taxpayer. Please consult with your own tax, legal, financial, and other advisors regarding your own unique situation.